Chapter 15 for Business Finance. In Chapter 15 in Business Finance, we talk about how companies raise capital. So there are a lot of different ways that companies can get the capital or cash they need to finance their business. One of those ways is through venture capital funding. This is also known as private equity funding. So venture capital is a type of private financing that's available for new high-risk businesses in exchange for stock or partial ownership in the company. So if you have a new idea for a business or some new technology or a prototype or something, and you'd like to turn that into a business, you can go out and try to find a venture capitalist that will fund you. You can either find individual investors that fund venture capital or a venture capital firm. They could also be some kind of a startup firm that finance various startup businesses. Usually when you sign an agreement with a venture capitalist, you give a part of your company up to the venture capitalist, or you give them a stake in any earnings. It's usually a pretty high stake in earnings, sometimes 40–50%. The ultimate goal is to take the company public, and the venture capitalist benefits then from any money because you'd sign a contract saying that they would benefit or gain a certain percentage of any future earnings. It is difficult to find venture capitalists. This is a who you know type venture. Venture capitalists are generally found through word of mouth or different investment opportunities. There are different kinds of stages of venture capital funding. It can be provided in multiple steps. So it's usually contingent upon meeting certain goals. So you would start with seed money. So the seed money is to help you create prototypes if you've created a new model of something. So it's just to kind of get your idea off the floor. The second stage, or mezzanine financing, helps you get into actual production, marketing, and distribution. So the seed money helps with initial planning, getting any staff or anything you need, supplies that you need to help get your idea off the ground. And then you move into production and distribution. And then eventually your product would take off in such a way that you could potentially sell your company or offer an IPO. Those are usually the two things that happen with small companies that do kind of these startups through venture capital funding. That's if they're highly successful companies. So how do you choose a venture capitalist? Well, you should really pay attention to what they are offering you. One, how much money do they have available? What is their financial position? What is their management style, especially if you're going to have to be working closely with them, if they want a direct say in the business and not just wanting to be a silent financial partner. You would want to check their references. Who do they know? So that's a lot of the who do they know that could also benefit your business. What kind of contacts do they have in the industry that you're looking to move into? And then what is their exit strategy? Venture capitalists are usually not interested in the long haul of a business. They're usually just interested in the initial success and getting it off the ground, and then they're moving on to the next new thing. So they will build in an exit strategy into their contract, and you should be aware of what that is. Do they require a certain amount of income before their exit? So what is their plan? The next way that we can raise capital is by selling securities or stocks to the public. So if we want to sell stock to the public, management needs to go to the board of directors and obtain permission to sell stock. Once they get permission to sell stock from the board of directors, they file a registration statement with the SEC. The SEC then examines the registration during a 20-day waiting period. During that 20-day period, no securities may be sold. So this is sometimes also called a quiet period. They also might have requirements during this time that the company can't make any big announcements or any big changes during the public to this at this time. And this is part of the prospectus. The prospectus is called a red herring. That is it because there's huge red lettering on the outside of this prospectus. That's how it's got its name as a red herring. And anything that the company announces during this waiting period that is not already as part of the prospectus and the registration means the company's initial offering will be delayed. So they need to make sure that during that time there's no new news or sudden changes. And then the price per share is determined on the effective date of the registration and the selling effort begins. There are multiple issue methods. So we can do a public issue, which is what I just talked about, where we have to register with the SEC. We can either offer to the general public and then it's traded on the stock market and anyone can buy it, or we can do a rights offer, which means that we offer only to current shareholders so that they can keep their same ownership percentage. It's very rare that an initial public offering would be offered as a rights offer because you have to have existing shareholders first. So we have the initial public offering, which is an unseasoned new issue. They haven't, this company has never had outstanding shares of stock in the market. And then what's called an SEO, which is a seasoned equity offer, which means that they've decided to issue more outstanding shares when they already have a current number of outstanding shares on the market. A private issue is an issue to less than 35 investors. So you have shareholders or equity holders, but you are only selling stock to a minimum number of people that you've already identified. And in this case, you do not need to register with the SEC before making sales. So we have all of these different ways of issuing new securities. So we have public, privileged, and private, or just public and private, and then there's multiple types of those. So the firm commitment cash offer is where a company negotiates with an investment banker to underwrite and distribute the new shares. So a specified number of shares are bought by the underwriters and sold at a higher price. In this kind of offer, the company is guaranteed the price from the underwriter, and then the underwriter, one of their fees is whatever they earn before between the first day ending price and the initial price that they set. So they might say our initial price is $10. We'll buy 1 million shares from you for $10 a share, and then they sell them for $12 a share on the stock market, and they pocket the $2 difference. A best effort cash offer is where the company has investment makers sell as many of the new shares as possible at the agreed upon price. There's no guarantee how much cash will be raised in one of these situations. Okay, they can use an underwriter, or they can just put them out in the stock market and not use an underwriter. In that way, they don't have an exact amount that is going to be raised. A Dutch auction cash offer. So this is where they have investment bankers auction shares to determine the highest offer price possible. So they'll kind of put feelers out there to see how many people would bid on them, and they use those bids to determine what the initial offering price is. Then a direct rights offer is where new stock is offered only to existing shareholders. Then a standby rights offer is very similar. It's arranged with existing shareholders only. A shelf cash offer. This is a non-traditional cash offer. So under a shelf sale, a qualifying company, and for to be a qualifying company, they have to be investment grade rated in the bond market. They have to have not defaulted on anything for 3 years, and they have to have over 150 million in outstanding shares on the market currently. In that case, they can just set a bunch of shares on a shelf and sell them over a 2-year period as they need to. And a competitive firm cash offer is when the company elects to award the underwriting contract through a public auction instead of a negotiation. Direct placement securities are sold directly to purchasers. In that case, whoever purchases those cannot resell the securities for at least 2 years. Sometimes employee shares that are given as part of a bonus package are very similar to direct placement, that you have stock options as an employee and you get shares of stock as a bonus, but then part of the requirements of that is that you can't sell those shares for a minimum amount of time. So what are underwriters? Underwriting services are a group of investment bankers that help market the securities and share the risk associated with selling issues. They help to formulate the best method for a company to issue securities, whether it be a firm cash offer or a Dutch auction. They help price the securities based on what they know about investments, what they know about their expertise, and then they help sell out all of the securities at the day of the initial public offering. So the price stabilization is led by the lead underwriter in the aftermarket. The spread is the difference between what underwriters pay the company and what the security sells for in the market on that initial public offering day. So investment banks in syndicate are divided into brackets, and firms are listed alphabetically within each bracket. So the higher the bracket, the greater the prestige. And underwriting success is built on reputation. When a firm is looking for an underwriter, they can take bids for underwriters. They can approach underwriters based on their reputation. This is an example of a issue that went out for the World Wrestling Federation as part of their initial new issue, 11,500,000 shares of stock at a price of $17 per share, and the various things you can see here. This is the list of the underwriters that are the company is using. Some of the most popular underwriters, such as Merrill Lynch and Bear Stearns and Company. So they have a U.S. offering and an international offering. A firm commitment underwriting is where the issuer sells their entire issue to the underwriting syndicate. So this is where I would come and say, I would like to sell 1 million shares of stock. Well, instead of just doing an IPO and putting 1 million shares of stock in the market, the underwriter buys those 1 million shares and then tries to resell them. That helps them make money on the issue. They make money on the spread between the price paid by the issuer and the price received from investors when that stock is sold. However, then it's the underwriter that bears the risk of not being able to sell the entire issue. This is the most common type of underwriting in the United States. It helps to guarantee an exact amount of capital that the company will raise from a stock sale, and it makes money for the underwriters if the IPO sells for more than what they predict it's going to sell for.